All right, why don't we get started? Welcome, everyone. It's great to have you online today for this webinar from Rixon Capital. My name is Luke Howes. I'm one of the co-founders and investors in the Rixon Income Fund. Really excited to have Patrick William on the screen as well, who'll be doing our presenting. He's the Managing Director of the Rixon Income Fund. And today is really about being interactive. Patrick has a presentation, he'll put it up on the screen. It's all about what's different about Rixon, what we're doing, our performance, and an update from the fund over the last 12 months. But this is designed to be interactive. So I'll be managing the Q&A. So the chat has been disabled, but you can put in questions into the Q&A. That'll feed through to me. And feel free to do that as we're going through various topics, and I'll keep an eye on it. I'll call out to Patrick and we'll ask some of those questions as we go through. So you don't need to wait to the end, although of course we can do questions at the end as well. So as you think of them, just jot them down and I'll find an appropriate gap in the discussion and we'll jump in and answer those questions and ask them. So thank you everyone again for joining, and we'll pass over the time now to Patrick.
Right, thanks. Thank you very much, Luke. Look, good morning, everyone. Thank you so much for sharing your time today. This won't take long. It's meant to give you a snapshot of what we do, why we do it very, very well, and what makes us unique. So the next few slides, I'm going to cover fund strategy, our investment mandate, the current portfolio, and year-to-date performance. Now, ahead of discussing strategy, I think a very logical starting point is to understand the domestic commercial lending space. So if you look at that graphic in front of you, if you're a high-quality borrower looking for debt of over $40 million, you're very well banked. The big banks, the large institutions, they're lining up to provide debt funding in that space, and you can generally access single-digit pricing. You then look at the $15 to $40 million space. That's really the target market of what I call the mainstream Australian private credit fund. You know, there are 15 to 20 players in the market. If you've got a good debt advisor, you've got a good business, you can generally get yourself a couple of good term sheets on the table to get yourself a good non-dilutionary funding solution. But when you come to that sub $15 million lending space, debt funding options become a lot more scarce. You're too small for the banks and the large institutions, but equally, you don't fit the mandate of the large and medium-sized private credit funds. Because, you know, illustratively, if you're a $400 million private credit fund, you cannot spend time diligencing, say, a $5 million loan, irregardless of how good the quality is, because it's a scale issue. Historically, what we've observed is borrowers in that $2 to $15 million niche have historically focused on source their capital from two areas. Option one is friends and family. They've got the benefit of being non-dilutionary and they can offer very friendly terms. The downside, of course, is they're not institutional. So your generous Uncle Fred and Auntie Nora might give you $4 million for your business. The challenge, of course, is they'll want half back by Easter and the rest back by Christmas. So it's a stopgap solution rather than a long-term solution. Option number two is to deal with the opportunistic lenders. They can offer you an institutional grade multi-year facility. The problem is their returns mandate is focused on gaining equity-like returns. So they'll also be looking to get anything from 2 to 20% of your business in warrants and options. Now, if you're an asset-rich borrower and you're generating positive cash flow, that is really not a very attractive option. Now, that is Rixon's target market. We go to the best of breed borrowers in this niche and we say, we can give you an institutional and non-dilutionary funding solution. We will work with you to grow your business over the next 1-3 years, and we will not touch your equity stack so long as you can meet our lending criteria. All loans we put out the door fit this formula. We require first ranking security. We require real asset collateral. So not intangibles, not a valuation report, not optimistic equity valuation that your banker or your accountant's provided. We want plant, property, equipment, receivables, or inventory, and we take registered security over that. These are assets that retain value and can be realized in a downside scenario. We require our interest to be paid in cash every month, And our pricing, which is floating rate, starts at about 14% per annum. Now, in return, of course, we don't touch your equity. Philosophically, the view is a borrower never gives economics away for free. So if you're getting equity, our view is you're either giving up security or you have insufficient security or you're not getting a sufficient return. So by eliminating that need to take equity, we can focus on delivering a very, very attractive risk-reward return on debt. Now, if you look at those 4 categories there, it looks very, very limited. If you think our mandate does look restrictive, it is. Philosophically, if you're an investor and you invest in, say, a small cap equity fund, what you're looking for is to access small cap equity risk and small cap equity return. So this is really no different. We offer a very specific target return for a very specific risk profile. Now, over the last 12 months, we've looked at 230 potential borrowers seeking nearly $2 billion in funding. Only 6 or 3% of that made it to due diligence, and we've executed on just over 1%. Our lending is predicated upon capital protection and delivering regular monthly income. And then we acknowledge it as it's a highly specialized strategy, and this panel really gives you evidence on how selective our underwriting is.
Patrick, we've just had a question come in, if you don't mind just pausing for a second. Will you do a deal with someone else as the mezzanine funder, as the mezz?
Absolutely. So long as we're first ranking, we're reasonably indifferent to any other funders, because they're all subject to a subordination deed. So in our view, we always see things from a downside perspective. If the business defaults, if the business goes bad, are we first in line? And do we have an asset over which we have first dibs, so to speak, to recover capital? So if there's a mezzanine funder or there's shareholder, in fact, most of our borrowers have shareholder debt that is subordinated to us.
Thank you. And for those who've just joined the call, there's the Q&A function at the bottom that I'll be moderating and passing those through to Patrick at the right time. So just pop your questions in the Q&A screen.
With this table you're looking at right now is a summary of our current loan portfolio. It's updated every month based on the most recent financials and asset valuations from our borrowers, and it's published in our monthly unit holder update. Now, if there's any questions on this, reach out to Luke and Luke will send it my way. But what I really want to draw your attention to is that LVR metric. Now, we always have a first ranking lien over the entire business, but that LVR measure only reflects the value of real asset security. So that 59.7% you see there assumes a nil equity value for these borrowers. Now, it might seem a bit aggressive, but it's actually the correct way to account for debt. Because the reality is the only time a lender calls on borrower collateral is when things have gone to custody. And if the borrower is challenged, odds are that equity is written off, written down, or will take months and not years to realize. And the only real asset that will retain value and is realizable are those real assets we've got listed in the second column. Those receivables, that equipment, that inventory, and that property. Now, to summarize our offering, we have a target return of 10 to 12% per annum with distributions paid monthly. We have a prescriptive formulaic lending mandate. All our loans are first ranking, senior secured, asset-backed, and pay a compelling yield. Our number one focus is on capital preservation. So once the executive team diligences a deal, we go to an independent investment committee for review and approval. The first question we're asked before pricing, before terms, is in a downside scenario, have you identified a path to be able to realize our investor capital in a timely manner at 100 cents on the dollar? Now, I want to dwell on the real asset security component for a moment. We've had investors ask, why don't you do property development? There's underlying asset. They're still very attractive returns available in the market. Now, there's two key reasons. One is they're not cash flow generative, so it doesn't meet the mandate requirements. But more importantly, the key issue is the underlying asset value. In a property development, the underlying asset value is a future assessed value. So illustratively, if you lent $50 million in debt to a $100 million property development, that $50 million is the hard cash, hard invested capital. That $100 million is a value on a piece of paper from 12 months ago based on certain assumptions that were valid at that time. So that generates two immediate risks. One, those assumptions can change, and they have. And two, until the project is actually complete, it's not worth $100 million when you've got nearly $50 million out the door. And if anyone thinks that's being a bit too cautious, if you picked up the AFR this week, Australian Unity has just published how they've got a first mortgage fund that funds property developments. They've provided $15 million in debt to a project that was valued at $23 million. Interest rates have gone up. The manufacturing of building costs have gone up, and there were weather delays. They required $7 million in additional capital to complete that project. So you look at that map, that's $15 million of debt, $23 million valuation, and $7 million additional capital now required. That asset is now listed on realcommercial.com.au. So that, when that loan was written, it was a 65% LVR. It is unlikely they're going to realize 100 cents the dollar, and it's very unlikely they're going to realize any of that capital in the next 3 to 6 months. And that is really why we focus on those real assets. Receivables turn over quickly. We only bank equipment and inventory that is easily liquidatable. We get an independent valuation report on equipment and inventory. With our equipment, we only use orderly liquidation value when sizing our LVR. And within that report, the valuer will tell us the identified pathways for liquidation. So if things go south, heaven forbid, Rixon Capital isn't running around like a headless chook. We call up a valuer, they step in, and they know exactly which market to take that equipment and inventory to liquidate at a deep discount, but sufficient to return our investor capital.
We've had a couple of questions come in, if I can just jump in there.
Yep.
So there's a few of them here. So first question is, referencing your previous slide about the deals that Rixon has done, what is the working capital facility and why is it only a 3% return listed there?
Fair question. There are a lot more footnotes when we disclose it in the monthly update. So that's a public facility. The business is called 3ME Technologies. Homegrown Australian technology. It's an electric vehicle engine maker. They make electric vehicle engines for the Bushmasters, for the Australian Army, and for mine vehicles. They've received $20 million in convertible debt from the Australian government. They've got a backlog of substantial contracts coming into play in the next 3 to 6 months. So they've got a reasonably long lead time. So the contract's monetized because they're obviously tier one counterparties, but they foresee a cash flow crunch at some point, and they'll need some capital to fund operations. No one wants to give them a $5 million facility. It's too small, and those who want to give them capital say they want a bit of equity because it is a very, very sexy business. So what we've done is given them an undrawn $5 million facility. They pay us 3% per annum for no capital deployed. And when the capital starts getting deployed, that loan will generate returns of in excess of 15% per annum.
Great, thank you. I'll just run through these in the order they've come through. So here's one, it's a bit of a longer question. There are long-established private credit funds that profess to be pure cash flow lenders who don't rely on collateral. They also tend to pass on returns far below that of Rixon's. What are questions investors need to be asking about such offerings?
It's a long question. It's a controversial one as well. There's several points to be made there. Rixon's a relatively new fund, and because we're new, we like to say, we've seen the market for what it is, and we're trying to adopt what we call best practice. So if you look at those bigger funds, I'll give you a more general answer. One of the reasons those cash flow lend returns are low is the fact that some of the really big funds in this market, by virtue of being first movers 3, 4, 5, 6 years ago, they take some of those loan economics themselves. So those cash flow loans are probably priced at 12, 13, 14, 15%. But what those credit funds do is they take that 15% return and they split it into a 4% establishment fee and an 11% interest rate. The fund manager takes that 4% and they keep that themselves. They then take that 11% interest rate, they deduct their 1 to 1.5% management fee, and they put the rest of that capital out the door. That's really what's happening with some of the big players. The challenge for investors is to understand that just because a player is large, just because all the wealth managers use them, does not necessarily mean they're the best risk-reward proposition. That's very much a call you've got to make as an investor.
So is there a specific question or two that you could ask to other investment opportunities you might be looking at in that space, Patrick, that could be helpful for people on the call?
Yeah, look, we've got a very, very healthy pipeline at present. So to talk about, I'll look at the board behind me with our deal flow. So a transaction that we're considering for December, January this year, so we're actually raising capital for it concurrently as we run through diligence, is a wealth management roll-up. Now, wealth management as a sector in Australia is becoming challenged because of increased regulatory obligation. So if you're a small player run by a 50-year-old, 55-year-old sole operator, you're not going to go back to university to get a degree to run the business for another 5 to 10 years. So there's an entire market of these advised book of clients. The long-term revenue, they generate 1% management fees of capital under management. They're all coming up for sale. So this very, very smart group out of Western Australia, they're picking up these books at very, very attractive valuations. They're also being very clever about how they buy them, because the immediate question you ask is, well, you buy these books, what happens if these investors drop off? So they're buying them at 70 cents per dollar upfront, and the residual payments are made over 2, 3, 4 years, subject to not losing any investors. This play is being backed by New York Stock Exchange investment manager. So the challenge that they've got at the moment is the Australian principals, the original founders, have effectively run out of cash. They put all their money into it to build this business, but they've got this huge pipeline of acquisitions. So they've really got two choices. Dilutionary debt, and they've got several term sheets for debt with warrants, or you call up your shareholder in New York. And their complaint, and they say it's a very happy problem, but it's a problem nonetheless. The American partner sends a check as and when required, but every check dilutes the Australian shareholders. So we're having a conversation to them about providing a non-debt funding solution. Now, indicative numbers show that piece of debt, if we put it out the door, would be $2 to $5 million on a 33% LVR on a facility that will yield 14 to 15% per annum. So that's our number one focus at the moment, but we've got 3 other transactions that we're working through with very, very similar economics.
Thank you. Just a couple more questions here. So when the fund is a little larger, how many loans would you ideally want to hold?
I'll take a step back. If you look at our risk-reward proposition, a cynic would say, well, you're getting all this asset security, you're getting first-ranking leads, and you're getting this incredible yield. Why aren't people lining up around the block to set up funds to compete with you? And the short answer is it's a niche strategy. We're writing loans of sub $10 million, and we're really harvesting this unloved $2 to $15 million lending niche. So the reality is this fund will never grow beyond $250 to $300 million. So that keeps a lot of the competition out. So within that niche, we estimate we'll never hold more than 20 to 25 loans on the books. And at maturity, those loans will range from $2 million to $50 million in size.
Excellent. So last question we've got here at the moment is, how does Rixon source investment opportunities and seem to deploy undrawn capital?
We've got several channels for deal origination. So we're very well known in the debt advisory and the finance broker industry. People know what we do and what our offering is. So we saw $1.5 billion worth of transactions over the last 12 months. So the brokers and the advisors bring us deals, but equally, we actually get very high quality transactions off the big 4 accounting firms and the golden circle law firms. Because I describe our lending universe as institutional grade borrowers who are just at that SME phase. So what you'll find is their shareholder agreements are drafted by Mint Ellison. They're getting accounting and finance advice from KPMG High Growth Ventures. And what helps us from our risk proposition is, if you've got a borrower operating at that level, you know their documents are in line, you know they're operating at best practice as well. In terms of deploying uninvested capital, look, the reason our returns are so good is because we don't hold large amounts of uninvested capital. So really, we only take funds if we can give it a hold, and we obviously hold a buffer of about $1 million, $1 to $2 million, just in case an opportunistic opportunity turns up really quickly. And also the fact that we like to be able to offer our investors liquidity within the contracted term. So the fund offers quarterly liquidity with 90 days notice, but we take pride in being able to give people their capital back in full or part well before then, because, you know, obviously if you want your capital back, you want it back today, not in 3 months.
Excellent. Thank you, Patrick. And thank you for all who have submitted questions so far. Keep them coming. Insightful questions leads to insightful answers. So thank you very much, everyone. Patrick, let you keep on going.
All right. Okay. Well timed, mate. We're going to our last slide now. So there's one thing to tell a good story. It's something else to actually showcase reality. You saw on the last slide, this is the book. This is the portfolio secured over a 60% real asset LVR. Our last 12 months saw investors receive an 11.8% net cash return. That's the upper end of our 10 to 12% target return. Now, if you look hard enough, you can find a similar, even higher returns in the market. But what you will not find is this level of return on a pool of first ranking, senior secured asset-backed loans on prescriptive lending. Which is to say, you know, if you invest in the Rixon Income Fund and decide you really haven't got time to read your unit holder updates, you know that every loan we write from now to, you know, when the trust expires in 80 years, fits that specific prescriptive formula. We believe the Rixon Income Fund has the best risk-reward proposition in the market. And, you know, sorry, I've just muddled my notes here. We've got the best risk-reward proposition in the market. And us as founders, we've got a substantial capital allocation within the fund, which really isn't a hard sell. You know, if we were running a speculative equity strategy, you know, 1 month you're up, 1 month you're down. But the reality is I've got pretty much all my liquid assets in the fund, and the fund pays me 0.92 to 1% every month. It's not much of a sacrifice. It's actually a very logical transaction for the founding team. Look, I'll leave you on this slide to digest what I've spoke about today, but please, if you've got any more questions, send them through.
Okay, just another couple here, Patrick, and please pop some more into the chat there. So one, you mentioned that cash is paid monthly on investments. Can you have your returns automatically reinvested each month?
Yes, it's a box you tick when you invest, and if you change your mind while you're an investor, it's a one-page form where you literally tick a box and put your signature at the bottom.
Excellent, thank you. And do you have any borrowers who are related parties to Rixon?
No, look, we would never permit related party funding. I just got off a call with institutional investors just now, and they were talking about how, you know, you've got property developers out there looking to set up their own private credit funds. And what we've observed in the market is this trend where you've got businesses that, you know, they run a private credit fund, they're delivering fantastic returns. If you read the information memorandum, you read the research report, there is literally one borrower, and the fund manager is the majority shareholder of that borrower. Now, it's disclosed on page 45 of the IM, but our house view is that creates incredible conflicts of interest. Because you as a debt investor are receiving, you know, an attractive 8, 10, 12% return, but your fund manager is making 30 to 40% returns off your money. You know, you can document all you want, but humans are humans, and you should never put people in a position where they have to make that sort of decision.
Excellent. If we have, here we go, we've got another question just popped through now. If you have any thinking of, pop them into the Q&A and we'll get them answered as we get closer to wrapping up. Question is, have you considered deploying leverage within the trust?
Look, the trust isn't permitted to take leverage. So there's no debt permitted within the fund. It's a direct equity return, so to speak. So if every dollar we put out the door works with no leverage against it.
Excellent. Now, just some other general things maybe about the fund, Patrick. I thought just while I'll ask while we'll see if any other questions come in. How long does it usually take to do all the paperwork and onboard and set up? What's that process like?
Look, we use the Olivia 123 platform for onboarding. So if you're an existing investor that uses the platform, it'll take you about 30 seconds. If you're not an existing investor, look, if you've got your documents lined up, an SMSF or a family trust, it's really 15 to 20 minutes. It's not an onerous process. It's all reasonably logical.
Excellent. And are you currently fundraising at the moment? And are there any deadlines that people should work towards?
Absolutely. Look, we're looking to raise $2 to $3 million for December, ideally, to pick up that wealth management roll-up, which we think is a cracking opportunity. We raise capital on the first business day of every month. So the next raise closes on the 1st of December, which I believe is a Friday.
Excellent. And we had the question earlier around how you source leads of businesses to lend to. I presume you're open for introductions if people know of any opportunities for lends or anything like that, or partnerships or opportunities for distribution.
Oh, absolutely. Absolutely. Please reach out.
Cool. And what are the best ways that people can reach out to you?
Look, I'm on LinkedIn, so send me a LinkedIn message. In fact, my email's on LinkedIn, so just drop me an email directly and I'll get back to you directly as well.
Okay, excellent. And I think your email is patrick.william@rixon.capital. Is that the one?
Too easy.
Excellent. Good. Well, we'll just give anyone a chance for any last questions to come through. But thank you all for your questions. Thank you for your attendance. We've had a great turn up today. This has been excellent. Appreciate all the questions as well. Nothing's coming through at the moment. So Patrick, anything you want to close with?
Look, thank you everyone for your time. I guess I'll throw in the key points of differentiation again, right? One is we have a prescriptive mandate. That makes us very, very different. We don't keep the upfront fees. That makes us very, very different. And because we're a niche strategy, I'm a co-founder of the fund. I'm portfolio manager and managing director. I speak to every one of my investors, and I am accessible to every one of my investors. So our view is, if you put your hard-earned capital into a fund, you should be able to speak to the person who makes the right decisions for you, as opposed to a 22-year-old graduate reading off a script. But thank you so much for your time, everyone.
Very good point. Thank you, Patrick. And if you'd like to catch up for a coffee with Patrick, if you're in Sydney, or a phone call or a Zoom, I'm sure all those things can be arranged. So thanks all for your attendance. Have a great day.
Take care all. Bye.